Good morning and welcome to this Tuesday, September 5th, 2023 edition of Trading Places Live with at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes as we prepare for the trading day ahead. Just a couple of things quickly to get out of the way. First, always like to thank you for tuning in. Really appreciate your support here on YouTube, all of our Earnings Beats Digest community members, of course, all of our loyal members at Earnings Beats. We certainly appreciate all of you. It actually provides us the opportunity to do this, to do what we do. We really enjoy this. I enjoy this. And so again, I just want to make sure I thank everyone for that. We did launch a new product this weekend. It is our EB Weekly Market Report. So in the past, we've had 5 daily market reports, Monday through Friday. We're actually, and they focused more on daily topics. We would occasionally take a look at some, longer term charts, but for the most part, it focused on daily charts, maybe 60-minute charts, and most of what's happening in the now. We decided to add this weekly market report because we did have a number of members saying, hey, I'm interested in the longer term. Not really a short-term trader. Could you spend some more time talking about the big picture? And so what we decided to do was a little compromise. So instead of having 5 daily market reports, we decided we would do 1 weekly market report, which is a focus more on the long term, the big picture. And then we would have 4 daily market reports, Tuesday through Friday, to go over more trading, short-term trading oriented topics and so forth. So from this point forward, on Sundays, I hope to have it published on Sundays so everybody can get it. It's a much more comprehensive report. Those of you who received it yesterday know that it's a much, much more comprehensive report. It was probably 6 or 7 times the size of what I normally do for the daily market reports. And so I think this is going to be a big part of our service going forward. Keeping everybody up to date on on the big picture. Even short-term traders, you really need to have the big picture, because if you follow a top-down approach like I do here at Earnings Beats, then you really should be most concerned, number one, with what's going on in the market. What's the big picture? Are we in a secular bull market? Are we in a cautious period within a secular bull market? Are we perhaps heading into a secular bear market? That's a really important thing to know. All of these things are going to be talked about and addressed in this report every week. We do have some long-term charts that I'll probably only show in that report maybe once a month, because it makes no sense to show it every week. But otherwise, there is going to be more of a focus on the big picture. And I think a lot of our members, a lot of you certainly will appreciate that. I'm going to spend some time later in this show talking about the big picture. And I'll go over this first report. I actually published an article over at Stock Charts, letting everyone at Stock Charts kind of know what we're doing in terms of this new product. And so I want to walk everyone through that. So we're going to get to that in a little bit. But let's go ahead and start the show off as we usually do. I'm going to give you a market update from what happened on Friday. So here we go. We got the Dow Jones Industrial Average rising about 1/3% on Friday. The S&P 500 gained almost 0.2%. The Nasdaq was flat, actually dropping a fraction. The mid-cap index up almost 1%. So a very strong move in the mid-caps on Friday. Small caps up 1.2%. So there was your leader. Small caps actually had a great day on Friday. Transports at this point, on Friday, up about 0.7%. So just a little bit more than 2/3%. But across the board, we saw mostly strength. Again, the one exception maybe was the Nasdaq 100, which dropped just barely, less than 1/10%. Moving on to the sectors, energy had a big day. And check this out. Energy, after bouncing off the rising 20-day moving average a couple of times, breaking out to a new high. There is a negative divergence in play, so we'll have to see if we get a reversing candle. That would add to a little bit of short-term caution. But if we continue to move higher, we may see that PPO just simply take off and eliminate the negative divergence. That's certainly a possibility at this point. Looking at that AD line, look at energy. AD line starting to turn right back up again. That's what you want to see. When price action starts to rebound, we're getting it there. Energy looks pretty good here. Although, again, watch for a reversing candle because of that negative divergence on the daily chart. And again, even if that were to play out, I don't know that we'd be looking at much more than a few dollars to the downside. I don't think it would create any kind of big selling, but it is something that we could maybe see a pause, and a reversing candle would probably be the next clue that might be in process. Materials up more than 1%, 1.1% on Friday. Materials also clearly now moving back up above the moving averages. This is big because when we're in these bull market advances, you really want wide participation. And when I talk about wide participation, I'm not talking about everything beating the S&P 500 every day, because that's impossible. The S&P 500 is what it is. You're going to have some outperformers, some underperformers. But what we want to see in wide participation is just groups, industry groups, sectors, major indices being healthy. And what I mean by being healthy is trading up above those moving averages. That's number one. Number two, having strong AD lines for the most part. And you see energy strengthening. Materials needs to maybe do a little bit more. It started to turn up, but it certainly hasn't shot higher at this point. That'll be something to keep an eye on. And then we've got financials, which rose 0.9%. This is a group, and really more value. You see the value stocks kind of leading here the first day of September. As we move through the balance of the year, I would expect more of this. Historically, even over the last 11 years, which has been part of a secular bull market where growth normally leads value, the last 4 months of the year, and especially October and November, tend to favor value stocks in a big, big way. So one thing I'm watching right now is just looking for this rotation, perhaps away from some of the growth stocks and more toward some of the value areas like financials, like industrials, energy, healthcare. All of these groups tend to do better in a value-oriented environment. So let's keep an eye on that. From a industry group standpoint, clothing and accessories, good day there, up 3.65%. Non-ferrous metals actually a little bit better, and this is what helped materials on Friday. But this group was up almost 4%. So definitely one of your leaders from Friday, seeing money roll back into non-ferrous metals, moving back up above the moving averages, starting to see that AD line turn back up again. By the way, clothing and accessories, that AD line's been horrible. So I'm not really sure that this, and if you look at the long-term chart on clothing and accessories, it's not really a group that you want to invest in and remain in for a long period of time. This group tends to have ups and downs and just kind of goes sideways, and not really one of your leaders. It's not like semiconductors or computer hardware with Apple leading the way and consistently pushing higher, or software or internet or automobiles, where we consistently see strength during this during a secular bull market run. Clothing and accessories a little bit different. You want to kind of catch those runs when they occur, but they're not, in my opinion, great long-term holdings. There might be some individual stocks in there that have weathered storms and continue to trend higher, but for the most part, this is a group that really goes up and down, very cyclical. Non-ferrous metals, as I mentioned, big day on Friday, gaining almost 4%. And then finally, the exploration production stocks within the energy space leading to the upside, gaining about 2.25% on Friday, breaking out as well. And check out their AD line. No mystery here. AD line breaking out along with price looks great. Moving on to the 10-year Treasury yield. Not really a whole lot going on this entire week with economic reports. There'll be a few out. I think the next really big economic report will be next week when we get the two inflation reports. We'll get CPI and PPI. I'll have to go back and double check the dates. They're either Tuesday, Wednesday, or Wednesday, Thursday. I'm not sure, but they are CPI first, PPI second. And then right on the heels of that, the following week, we have the Fed meeting. So it's going to be, some pretty interesting times here over the next 2 weeks. And we know historically, September, not a great month. I shouldn't say not a great month. It's a poor month. It is the worst of the 12 calendar months historically, dating all the way back to 1950 on the S&P 500. So this is a month that we want to be a little cautious. Now, in my research, the first half of September is okay. I think the annualized return on the S&P 500, or the average annual return on the S&P 500, is about 9% going back to 1950. If you look at the performance in the first half of September, the annualized return, the average annualized return during the first 2 weeks of the month is about 8%. So it's almost on a par with what we expect throughout the year for the S&P 500. So it's not that bad. The second half of the month is bad. I don't have the annualized return right here in front of me. It was in our seasonality report that we issued to members. But I mean, it's a minus, probably somewhere in the neighborhood of about minus 20%, 25%. I don't recall exactly. Second half of September is rough. Historically, doesn't mean, it doesn't go down every year, but it can be rough. We got a Fed meeting coming up during the second half of September. We've got the CPI and the PPI out next week. So there are some things that could spark, a little bit more selling maybe. But between now and then, I don't know, maybe we go back on the S&P to 4,600. Wouldn't surprise me. I really think right now we're in a period of consolidation. I think we established the low on the S&P 500. I'm going to look at that chart in just a minute. In fact, let me get back to this 10-year Treasury yield, because right now we've got an update. We're at 4.23%, up 6 basis points today. So we're making a move back up with the CPI and PPI reports looming and the Fed coming up on, I believe, the 20th and 21st. I think that's the dates. Well, it would be 2 weeks from today. Today's the 5th, actually 19th and 20th, I guess, is when the Fed meets. And I believe it would be the 12th and 13th, or the 13th and 14th, that we would be seeing the PPI and CPI reports coming out. The CPI first. But I'll double check on that, and I'll be talking about that a lot throughout the week. So if I'm off by a day or whatever, no biggie there. Just remember, it's next week. You need to be aware of that. Okay, so let's move on and talk a little bit about the S&P 500, because I think down here on the 18th, I actually wrote an article over at Stock Charts. I've been talking to members. The equity-only put-call ratio became very, very pessimistic. We had an extreme reading, 5-day moving average reading of 0.85 on the equity-only put-call ratio. That level has historically marked significant bottoms, and it happened right here. So we're rallying. I wrote the article. We'll come back to this. I think it was an article that I wrote. Yeah, it was. Let me just go back here. Are you ready for a huge rally? See the date right there? August 18th. I would say one of the things that separates earnings beats from a lot of folks is a lot of folks tell you after the market goes down that we've had a correction. We tend to tell you ahead of time whether we think the market's about to reverse to the downside, to the upside. And I think it's uncanny a lot of times how the timing is almost impeccable. And this was the latest example. I mean, I would say that was pretty good news, pretty good information to have on August 18th. And I think did that in the morning around 10 o'clock. So it was literally when we had gapped down. And what have we seen since then? I mean, now we've had 2 weeks of great action. We went from, I think, a low of 43.37 to Friday, a high of 45.41, 200 points, over 5%, or actually almost 5% in 2 weeks on the S&P 500. I think that's a pretty good rally. So a lot of what we look at in our weekly market report are things that I write about. I mean, we're going to keep our members in the loop on a regular basis so that you can better understand what's taking place in the stock market. Anyway, I think that low right there is a big low now for our period of consolidation. 43.37, I think, was the low. And if you recall, the August high let's go back just a little bit further. But that August high right here that we needed to clear from a long-term perspective to reverse the pattern of lower lows and lower highs during the 2022 cyclical bear market, that August high was really important. That was 43.05. We took that out in June, and now we've gone back down, and essentially we haven't quite hit 43.05, but we've gotten close. I think a worst case scenario is intraday we go below this 43.37 level, or let me get that level, make sure it's that's the number. 43.35, sorry. 43.35. I think worst case scenario, if things turned ugly again later in September, is maybe we go intraday below 43.35 and maybe test 43.05. I don't think we do much more than that to the downside. If we do, I'll say I'm wrong, and I'll probably be pretty much in cash at that point. I think that would be a pretty significant short to intermediate term move to the downside. So keep that level in mind to the downside. The recent low, 43.35, that previous August high, which now should hold as support, 43.05. That 30-point range, I think, is a big one for support on the S&P 500. To the upside, we got 4,600. Technically 45.98. That's where we opened. That was the high open or close that we saw recently. That was the end of July. And, you know, if we can get through, I think we go to all-time highs. And I think we're going through. I just don't know if it'll be in September. It could be in September. You know, I give you historical information because I do a lot of research, but history doesn't necessarily mean that's what we're going to do. It just gives us another clue. And you try to put all these clues together, put that puzzle together, and figure out, get an idea of what the market is most likely to do, not guaranteed to do, what it's most likely to do. And so right now, I just think we're in the sideways consolidation. Honestly, I'm not sure if we're going to be up today or down today. I don't know if we're going to be up or down this week. Rest of this month, from where we are right now, if you said, where are we going to be on September 30th? Are we going to be higher or lower? I probably could flip a coin. I don't know. I think we're going to be in this range. I think there's a chance we break out. I think there's a chance that we could break down. I think that's slimmer. But, you know, trying to call the market tomorrow or the next day, I mean, you can get reversing signs that give you a pretty good idea of feeling like, hey, we're at a bottom or we're at a short-term top, that sort of thing. I mean, back in the middle of July, I think it was July 18th or 19th, right in here, I was talking about a top. We ended up going a little bit higher, but that proved to be a pretty good top. So I can kind of see signals from time to time that help in the short term, calling tops and bottoms. But when you're in a range, I have no idea where we're going within this range. Don't know. I just feel longer term, we're going to break out of this range to the upside. This may turn out to be a cup. It could turn out to be, let's see if I can just do the last 3 months. I mean, it could be a situation where, I don't know, we top, we come back down here. We maybe this is the left side of a neckline. And then we went down, put it in the head. Here's the right side of the neckline. See that line coming across right there? Maybe we touched it. Maybe we go back down to the 20-day moving average here and put in an inverse right shoulder and then make a move to the upside. I don't know. I'm looking for patterns. Maybe this turns into being a cup. Maybe it's just, maybe we go all the way to 4,600 before the middle of the month. And then second half of the month, come back down, maybe to the moving averages. We could have equal highs, rising lows, maybe an ascending triangle forms. I'll be watching the pattern unfold, and I'll be looking for the clues that tell us, hey, the coast is clear, or hey, we got some more problems ahead. And right now, I just think we're in the middle of this range. All right, Nasdaq 100. I'm going to go through the rest of this quick because I want to get to the article. Nasdaq 100 looks very similar. I don't really see much difference here. I will say intraday, money is starting to rotate away from the Nasdaq and toward the S&P 500 intraday. Not really seeing it yet when you consider gaps, but intraday, we're seeing a little bit more rotation away from the Nasdaq. That's important because the fourth quarter tends to favor value. We're starting to see signs that Wall Street might be prepping for that. Russell 2000, I still like the overall performance here. I still think this group looks strong. I think this group is going to be a leader in the fourth quarter throughout the balance of the year. I think the IWM will outperform the QQQ over the last 4 months of the year. Time will tell. I've been looking for it recently and it hasn't really been happening, but I still believe we're going to see it in the fourth quarter. But overall, getting back up above the moving averages looks pretty good. I did point out last week that many of these indices have hourly negative divergences. The IWM is one of them. Notice we were going higher. PPO keeps going higher. The move on Friday, higher high. There's your lower PPO. So I grew more cautious in the short term on Friday. Took all of the proceeds from my leveraged ETF on the IWM, which was the TNA, and pretty much just parked it in cash. I've got a little bit. I moved some of it into the IWM. I still have the IWM and the QQQ just in case we go higher because I am bullish, but I'm not in leverage because of some of the things we talked about. The negative divergence here, the month of September, the problem with not really knowing we're in the middle of a range. That's not really the time to be in a lot of leverage. So I'm just kind of taking it easy. I'm mostly in the market at this point, but strictly the ETFs that track the major indices or a couple of the major indices on a one-to-one basis, no leverage. And as I mentioned, I may not be back in leverage the rest of this month. I'm going to see how things play out. I mean, if we get a sell-off, we get back down into the 4,300s, I'll maybe even into the 4,400s. Or if the IWM were to pull back, maybe back near this gap support, 188, get back near the 50-day. Yeah, I could start maybe looking at leverage. We'll see. Transports, trying to get back through the moving averages. That's a group, especially if money starts to rotate toward value, you should see this transport group break back above these moving averages. So watch for that. Chart of the day. Anybody interested in the chart of the day? I always encourage you to go to earningsbeats.com, scroll down and sign up for our Earnings Beats Digest newsletter. It's 100% free. There's no credit card required. You can unsubscribe at any time. I promise you, you're not going to hurt my feelings if you don't feel like what we provide is helping you in any way. We try to make it educational. We try to help, provide some charts that might help in your trading if you're so inclined. But if you don't feel like you're getting anything out of it, unsubscribe. That's what I do. If I try something that's a free newsletter and I don't really think it helps me, I just get rid of it. You're not going to hurt my feelings. But if you haven't tried it, I would encourage you to do so. We have a lot of folks, a lot of these free newsletters, when you write them, you lose a lot of interest. A lot of folks stop opening. I can tell you, we have a very, very high percentage of folks that open our newsletter every day. So if you haven't checked it out, please do. Comes out Mondays, Wednesdays, Fridays. Yesterday was a holiday, so we issued one today, and I'm going to show you right now what it was. ICE, baby. Intercontinental Exchange Group, ICE, just recently broke back out above the high that we had in July, coming off a PPO centerline test, starting to point back up again. This is in the financial area in investment services. This is a group that tends to do really well. This stock in particular loves the fourth quarter. And so I think when you combine a strong stock technically, and keep in mind, financials haven't been the best area of the market. Investment services has not been particularly strong. And yet here's a stock breaking out to 52-week highs. So you have a leader, you have a stock that's in an uptrend, and you also know you have a stock that seasonally likes the rest of the calendar year. So ICE, and I'll show you the weekly chart. This stock took a beating back from April through the early part of June, maybe from March, really through the early part of June, 3 months, went back down, put in a double bottom, and then finally broke above this. I mean, it took months and months to finally get above 110, but now we're through it and we're holding 20-week moving average test when we go back down and test them. The weekly PPO is strong. I think the stock continues to go higher. I think it'll be a winner through year end. Just my opinion. But this is the type of thing that we like to talk about in this newsletter. So please check it out. All right. Last thing I want to talk about is this new product launch. I actually, if you go over to Stock Charts and click on articles and then find my blog, actually, you can go to articles. Let me show you. You can go to articles. Right now, it's the third one on the popular articles. My latest view of the current market action. Click on that. And all I did really is reprint for everyone over at Stock Charts our new product launch that I sent to members yesterday. And this is our weekly newsletter. So kind of walk you through this quickly. Give a weekly market recap, talking about what led in the prior week from an index perspective, major index perspective. Then we get into sectors. Here's the weekly performance of sectors. You can kind of see materials, energy creeping up there. Technology still had a pretty good week. Not quite ready to pass the torch. It passed it a little bit on Friday, but for the week, it was strong. This will be a group to watch, especially as we start heading toward the Fed next week or in 2 weeks, because I think money is going to rotate more back toward value. I just think anytime you start thinking interest rates or, already the 10-year Treasury yield starting to move back up again a little bit, we may see a pause in technology, especially areas like the semiconductors, which have been absolutely on fire in 2023, but they're showing signs of wear and tear, and I'll show you that in a minute. But there are the sectors, top 10 industries last week. So pull those up, show you how much they gained. Actually pulled up a couple of the charts showing you how, they've been strong, but home construction right here looks a little risky. I'm not saying it can't go higher. When I look at technical analysis, I'm trying to evaluate my risk. I'm not trying to determine a guarantee on what's going to go higher next week or what's going to go lower. I'm trying to evaluate how risky certain areas are to be long. If I believe we're in a secular bull market, which I do, I'm going to want to be long. But evaluating risk is a part of technical analysis. And so when you look at an area like home construction and you see that its PPO on a weekly basis has reached 8, above 7.5, and you look at the history over the last 11 years, look at what has happened when we get that kind of strength in home builders. Here's what happened over the next 9 months back in 2018. Here's what happened over the next 3 months in 2020. And here's what happened over the next 4 to 5 months in 2021. We struggle when we get up to this level. So here we've come down. Is that going to be it? I don't know. But if we go back up, we're going to have a negative divergence. And if you notice, when we went back up on these tops, we kept showing these negative divergences. Eventually, we took a pretty big hit. I mean, we dropped probably 40% in 6 months. I don't think we're there yet with this group, but there's a lot of good news built in. Rates could start coming back down, and you might think that's good for home construction, but that might go down with it just because it's been going up with rates going up. Market doesn't always make sense. Anyway, just be careful when you see that. Semiconductors, I point out the same thing. The PPO, weekly PPO hit 10. The last time it did that throughout this secular bull market was never. This is the first time that we've gotten that much distance between our 12-week and 26-week moving average. 10%. Anyway, I think anytime that we get these, moves on the PPO, these tops, I'm not sure why I didn't do this one right here. That one went sideways for a while, but you can see what the semis have done. I mean, they certainly haven't gone screaming higher. And so after this huge run, I think the risks are starting to turn more toward those on the long side. This is a group that really could use a few months to pause. And they typically do in the fourth quarter. So be careful with semis. Bottom 10 industry groups, there they are. Talked about a couple that this healthcare providers group coming down, hitting this trend line. This could be a great area. This is a more value-oriented group that could see money rotating from more aggressive areas, more growth-oriented areas, into areas like the healthcare providers group. Then we've got recreational services. Talk about that. Anyway, I could go on and on. Give a lot of good information here. The top 10 stocks in the S&P 500, Nasdaq 100, bottom 10 stocks. And then I get into a lot more, and I'm going to get running because we're after 9:30. But here was the big picture, and this is one that I think not enough people look at. When I talk about perspective, this embraces perspective. The stock market goes through these grand super cycles, and you go through many. This is a monthly chart. So you can see we go through these secular bear markets where we don't go anywhere for many, many years, sideways, very, very awful markets. 2000 to 2013 was like that. We went nowhere from the high in 2000 until April of 2013. We did not go higher. 13 years. And then you go into a bullish period where you start to make up for it. And this is what we're in right now. 20 years in the 80s and 90s, 20 years in the 50s and 60s. I believe history is repeating itself, and we've got 20 years. We're 10 years in. I could be wrong, but if I am, I'll get signals that'll tell me I'm wrong. I'm not seeing any of those signals right now. Anyhow, read the rest of the article. Go over to Stock Charts. And when you get over to their homepage, simply click on the articles tab right here. And then you can either click on it here, or if you're ever looking for my blog, just hit this drop-down menu and just go down to Trading Places. And you can also, by the way, I will take you all the way to the bottom, because if you go to the bottom, well, it's not, maybe because I'm already subscribed. You should have an area below my article and my sign off where you can subscribe to the blog. And so make sure you do that. Don't miss any of the articles. It's free, by the way. Stock Charts doesn't charge anything for it. And they don't use that, as far as I know, they don't use it to market to you or anything. They simply will send you, if you subscribe to my blog, they'll send you to your email address as soon as I publish. It'll immediately be sent to your email. So check that out. Make sure you subscribe if you haven't already. And that's it. So let's take a look at the dashboard. Let's see what's going on with the market. Dow up 22, S&P down 4, Nasdaq down 46, small caps down 1.36%. So pretty decent move to the downside there. Looking at the IWM, let's go back to that hourly chart. See, I mean, it's dropping below the 20-day now for the first time. Another quick move. I mean, if you were in the leverage, we get back down, 188s down to 187s. If you want to be aggressive, you could maybe work your way back in to the TNA as the IWM drops. The TNA, by the way, mirrors the IWM at a 3-to-1 clip. But I always buy or sell the TNA, any leveraged ETF. I always buy or sell it based on its underlying index. And in the case of the TNA, it is a 3 times bullish ETF versus the IWM. Anyway, that's it for me. Appreciate you tuning in. Again, check out that weekly market report over at Stock Charts. If you're not a member, we have a 30-day free trial. Go over to Earnings Beats, and when you're at the page right here, start your 30-day no-cost trial. You'll get our weekly market report for the next 4 weeks and everything else that we have to offer, which includes, by the way, tomorrow's live trading room, which will start at 10 a.m. So anyway, hope that brings you up to date a little bit on the markets. And I hope you have a great rest of your day. I'll be back tomorrow, 9 a.m. Eastern, for your next Trading Places Live. Be sure to click the like button below and subscribe to our YouTube channel. It'll certainly help us and also help you. Anytime we do any kind of a live show, if you've got your notifications on, you'll be notified when we go live. Have a great day, everybody. Happy trading.